Hey everyone, I'm the BTS Trader. I backtest market data to help you make better trading decisions. Today, we're going to look at how different type of order entries can affect your strategy. But before we begin, hit the like and subscribe button. For those who don't know, there are 3 basic order entries we can make when entering and exiting our strategy. The first, which I'm sure most are aware of, is the market order. As the name implies, you're entering at whatever the market price is, and the trade should be executed almost immediately at the current bid or ask price, depending if you're going long or short. The second is entering or exiting on a stop. Best explanation is by example. Let's pretend the price is like 100. You put in a stop order at 110. When the price hits 110, your order is turned into a market order and is filled at the bid ask. Generally speaking, one might use a stop order when you think the price is going to break out into a trend. The third is entering or exiting on a limit order. Here, let's assume again like this is $100. You put in a long order to enter a long at like 90. When the price goes to $89.99, you're filled at $90 or better. Generally, traders use this to quote-unquote fade the market. For example, if the price has been heading south and the trader believes that 90 is the support level and will reverse back to like 100, they will put in a limit order at like 90. So for this strategy, I use a simple price action strategy to enter and exit the SPY on the 65-minute chart, as you can see here. In a future video, I'll explain more about this specific strategy, but for today, we're just looking at how different order entries can affect the strategy. The first strategy performance report is generated by using market orders. So you can see 17.7 in net profit, 215% return on account, a drawdown of roughly 10.5, 355 trades, and basically 71% profitable. Not great. We've definitely tested better strategies on the channel. Sharpe Ratio is red. In the market 60% of the time. Definitely not a very good looking equity curve. We've seen better for sure. As usual, the biggest drawdown is here in March 2020. The average trade is roughly $50. The average bars in the winning trades are less than losing trades, so that's not great. At first glance, the annual analysis doesn't look too bad, but then with a closer look, we can see basically 3 break-even years here and here, and definitely one big loser that wiped out these 2 years of gains. The next strategy performance report was generated using limit orders, and we could somewhat see the performance isn't too different. 17,000 in net profit, roughly the same in the return on account, drawdown, and the percent profitable. But the big difference is that we see that we generated actually 100 less trades. Sharpe ratio is still negative. I believe that this is pretty close to what we saw in the last strategy. The equity curve looks pretty similar. We have less trades, 100 less trades, so you can see that the average trade did go up a bit to 67. The number of bars in a losing trade is much larger than before, so that's a big negative. Once again, very similar annual report, but this time those break-even years are red right here, and we still have that big loser of a year right there in 2018. You can probably guess I saved the best for last. Here's the strategy performance report if we entered in on stops. We basically doubled our net income from 17 to 36,000. Our return on capital on this strategy is 925% versus like 211%. We decreased our drawdown by basically $4,000. We did generate a lot less trades, only 84, so that's not great, but our percent profitable is roughly the same. We see the Sharpe ratio is now 0.49. I mean, very close to that 0.5 that I always like to look for. We're actually in the market even more, even though we're taking a lot less trades. So we're swinging. I mean, you could maybe consider it's almost like a buy and hold a little bit, to be honest, but we're doing better than a buy and hold strategy. Equity curve looks really nice here. Bottom left, top right. Small drawdown in March 2020 and roughly pretty smooth, a lot smoother than the last strategies, let's put it that way. So a lot less trades, like we mentioned. Percent profitable is roughly the same. So we have a lot bigger average winning trade since we're trading significantly less than before. And here's a good sign right here is that the average bars, number of bars in a winning trade is now larger than the average number of bars in a losing trade. So we like that. So now we have 2 break-even years and 1 year that's a loser. But you can see this is a lot less than the other strategies. The other strategies produced something like 5,000 in a loss for 2018, which wiped out 2 years of gains. But now it's down to 1,000, and these are just basically break-even years, so where the strategy really didn't perform at all. So there you go. You can see that just by changing our order entry type, we increase our strategy performance substantially. By changing from market to stop orders, we increase this particular strategy's net income by double, lowered the drawdown by nearly half, and essentially lowered our risk. We made more money and risked less. Please note, the point of the study is not to tell you to use stop orders. The point of the study is to show you how testing different types of entry and exit orders can help improve performance. That's it for this video. As usual, if you want more tips on how to improve your trading strategy, then hit that like button, subscribe, comment, and I'll see you next time.